Hi, I'm Rick Kaler. Thanks for joining me. The concept of socially responsible investing is far from something that's new. The first SRI fund actually appeared in 1952. Since then, these funds have used social and ethical screens to exclude companies that sell products like tobacco, alcohol, or firearms from being in your portfolio. You might not have heard of the next generation of SRI funds called ESG funds, which means environmental, social, and governance funds. Social responsibility is just 1/3 of the expanded focus of these funds, which also look to include companies that are sensitive to the environment and have more holistic corporate governance. In recent years, ESG investing has really taken off. According to a July 11th, 2018 article in Forbes, The Remarkable Rise of ESG by George Kell, there's over $20 trillion invested in ESG funds. That's amazing. It accounts for 25% of all the professionally managed assets in the world. I had no idea it was that huge. There are currently 275 ESG mutual funds and ETFs from which to choose. Yet, one facet of investing in ESG funds is really misunderstood. While ESG investing may help you feel better about yourself, it doesn't actually impact or hamper the companies you choose not to own in really any way. Now, this might come as a surprise to many ESG investors who commonly believe that by not owning the shares of an offensive company, they're restricting the flow of capital to that company, thereby imperiling its existence. But for the most part, that just isn't the case. Listed among the worst offending companies by several ESG organizations that I came across are Philip Morris, Walmart, Tyson Foods, Pepsi Corporation, Coca-Cola, and Chevron. Of course, there's many scores, hundreds of others, but these seem to be at the top of almost everyone's list. No dedicated ESG investor is going to have these companies near their portfolio. However, none of these companies would care or be hurt in the least if you didn't own any of their shares. Now, why? The only time a company benefits from the sale of stock is when the company initially goes public. That's called an initial public offering or an IPO. Or it issues additional new shares to raise capital. These are actually fairly rare events. Most stocks are bought and sold in the secondary market through exchanges, like the New York Stock Exchange. These platforms just simply facilitate transactions between individuals or between institutions wanting to buy or sell shares in a company. The money exchange is between the buyer and the seller. None of the money goes to the company when the shares are bought on an exchange. Another way that companies receive funding to support their ventures is to borrow money from investors. This is called issuing a bond and is similar to an IPO. Only the investor receives a promise from the company to pay them back at some future date and receives interest on the loan in the meantime. So shares are owning the company, bonds are making a loan to the company. Just like stocks, bonds are only issued by a company once. From then on, buying and selling bonds is done on the open market, similar to the exchange. None of the money paid or received goes to the company. So if you want to punish a company, don't buy stocks or bonds it issues directly. Otherwise, excluding its shares from your portfolio has no effect on the company's profits or cash flow. But if no one bought a company's shares on the secondary market, wouldn't that have an impact? Well, of course it would. The demand, if that demand for shares dries up, then the company's stock price plummets, arguably goes to zero. Well, you got all those executives being paid in stock options, so they would certainly feel that. But the problem is that the demand for the shares of these companies isn't going to go away as long as they remain profitable. If 25% of the investors purchase ESG funds, meaning 25% of investors are not going to purchase the shares of offending companies, well, it still leaves 75% of the market that's willing to buy these companies. And if you think about it, if enough people boycotted buying the shares and the prices of the stock started going down and they're profitable, that means their profitability rises as a percent of what you pay for the stock. That just isn't going to last for long. 20% of the stocks owned are owned by passive funds, and they own the entire market. So they will always be buyers. So next week, I will discuss the profitability of ESG funds and suggest another way to align your money and your beliefs. Thanks for listening.